So my name is Sylvest. I'm co-founder of Tradeshift. So we are a company that was founded in 2010 with a vision to connect every company in the world in order to create economic opportunity for those that participate in that network. We really focus on the collaboration between companies. So we are business to business player, and we focus on the hard transactions between businesses. So things like purchase orders, invoices, goods receipt, anything related to the financial side of the supply chain. And we are today more than 1.5 million companies in the network, and transaction close to $500 billion a year in the network. And coming from the B2B space, I think one of the things that led us into the blockchain space was kind of the realization between, the difference between what really happens in the e-commerce space and what happens on the B2B scene. And one of the things to realize is like, while everything about the e-commerce has been brought about through digitization and social networks in the B2C space, you have in the B2B space, so everything that happens in supply chain, you have at least 9 transactions happening for every transaction that happens in the B2C side of things. Yet more than 90% of all the transactions that happens in B2B, they are not digital today. So there's this kind of huge mismatch between the level of digitization in the B2C space and the level of digitization in the B2B space. And that's really one of the reasons why we started the company. That was to say, some of the strategies you used to bring about the revolution in e-commerce, you must be able to apply the same principles to the B2B space. And I think what really made B2C take off and the social networks that today are driving demand, that is really incentivizing users to join these marketplaces, these networks of demand and supply, and very much incentivize users by giving them access to free stuff, like free services, free content, and similar things. And we haven't really seen the same dynamic played out in the B2B space. So we basically asked ourselves that question, like, how can you actually incentivize supply chains to digitize? And very much believe that the key to that is in, amongst other things, it's in access to finance. And this is kind of where our trajectory and what is happening in the blockchain space, those two trajectories, they met, because you have a few key transactions in the B2B space, like the purchase order, the invoice, where you have promises of buying something or promises of payments. And if you could turn these into to actual digital assets that could be executed with some reliability and turned into assets that can be traded, that's a very, very interesting prospect in terms of giving companies access to finance. So that's really the question here for us. What if we could solve that with digital technology? And as we started in 2010, we were definitely a non-blockchain player. So our focus was very much on the very basics of digitizing transactions, bringing things on a common standard form. And what we typically go to large, Fortune 5000 segment enterprise buyers, and then typically starting by digitizing electronic invoicing for their entire supply chains, but over time moved into other things like marketplaces, ordering financial services, and so on. So today we are the largest B2B network that is focusing purely on this kind of transactions. I mentioned 1.5 million companies in the network, transacting close to $500 billion a year across 190 countries. So really serving the big global and very diverse supply chains here. And if you look at these supply chains, you will start seeing an interesting pattern, and that is they are like small waterfalls of held up liquidity. So typically, someplace you have a very large buyer that is generating a lot of demand throughout the supply chain, and as you know, in business, typically there are payment terms involved that can be 30 days, 60 days. And that means at every step in the supply chain, you will have this liquidity gap when you're going to pay your salaries or your sellers. Some places in these chains, you have loops of liquidity and so on. But overall, if you look globally at any point in time, it's $9 trillion in liquidity that is locked up between companies. So that's simply just buyers owing money to sellers, $9 trillion. And the key challenge here across the world is that liquidity gap. And I think we saw it on the last financial crisis, and we see it again here during the COVID crisis we have right now, that as something like this happens that systemically affects the whole financial system, you will see companies holding on to their money, and that trickles down to the supply chain. In the last financial crisis, we saw payment terms extending to 9 months, 12 months, and even beyond that. So basically, suppliers' payment getting delayed indefinitely. But what if we could actually do something about this? So let's say we could incentivize companies based on their behavior on the supply chain. So if you have buyers owing money to you, one of the use cases here is deep tier finance. So today it's very common between, let's say, large buyers and sellers to have some sort of early payments programs in place. So basically, you plug in a funder in the relationship, and instead of getting paid on day 60, you get paid on day 1 or 2 against a rebate on what is outstanding on the invoice. Deep tier finance is basically the idea that you can extend that credit further out in the supply chain. So if you have $1 million outstanding between a large buyer and a seller, what if further payments down the line could be guaranteed in the owed money in that tier 1 of the supply chain? That would address a lot of the credit gaps, which on a global estimated base, only 15 to 20% of all the credit needs of companies are today being served by banks and other sources of funding. So it's a big global problem. In fact, it's on the top 3 of the World Bank's list of challenges for SMBs globally as barriers to growth. Another use case is FX. So in the global supply chains, they are very often international, and that's a rapidly accelerating trend. So even you have the micro multinationals. So increasingly, companies deal with cross-border payments, and FX is a major cost in this. If you can save $10,000 per $1 million in cross-border by using alternative infrastructures, that can be a pretty nice saving for most companies. And finally, you have other ways of incentivizing. So let's say today you have limited visibility into supply chains, for example, in scope 3 or in the extended supply chains, and what is the carbon footprint. And today, the only method that is really used, that is push method, where very large buyers try to force requirements onto sellers downstream. But what if you could reward sellers if they improve in for example, sharing information about their production practices or CO2 footprint downstream in the supply chain against rebates on, for example, financing. So when we started working with Monero last year, one of the questions was, you know, could blockchain have the potential to leapfrog open banking? We know open banking is a vision that goes back 15 or even 20 years, and an attempt which you can see also replicated in many other regions to liberate the financial sector and open up for competition for many more companies to offer financial services. Yet we have also seen that the financial institutions' resistance to these regulations have so far been fairly successful. So we do believe there are opportunities to leapfrog that. And one of the ideas here was to say, basically, what would happen if you put invoices on the blockchain? And instead of have the separation between a document that says what I'm owing you and the payment, actually combine those two things into what you could call a smart invoice. So imagine invoices that settle themselves automatically on chain. So coupling the settlement itself with the promise. And if you could do that, let's say every time a buyer accepts an invoice, you know that invoice is going to pay itself guaranteed in 30 days. You have an asset suddenly that is as good as money. So if you can issue that kind of asset, it also means you can trade it and you can use it in marketplaces and you can extend it throughout your supply chain. So that very simple asset suddenly opens up the potential for completely new types of financial services that can cover whole supply chains, as well as promised to do that with a much lower friction than you see in traditional B2B financial services like SCF, open accounts, financing, factoring, and dynamic discounting, which have very high friction and high switching costs. And we actually went ahead and actually proved that this can be done. So Tradeshift and Monero together, we executed the world's first smart invoice settlement together with IKEA Iceland, using Monero's licensed e-money. And that was kind of key to this, because we knew you're not going to execute anything related to business-to-business transactions unless you understand it's done in a compliant way and in a way that your accountant can understand and easily sign off. So the e-money license regime actually provided a very nice way of doing that, a clear pattern that is known to all companies. And then combining that with taking the invoice asset as a self-executing asset and doing that. And we did that in a few ways, both directly between a buyer and a seller, but we also went ahead and proved that you could settle transactions in 2 tiers in the blockchain based on the same outstanding credit between 2 parties. And even better than that, you could do that at a lower transaction cost than if you did this in a traditional banking infrastructure. And kind of just to tease the banks, we executed those transactions on a holiday, just to show that there are no limits here. A good question, and actually that's kind of where we started our search, because I do think there are some very interesting stablecoin projects out there. But what is also very clear is that a stablecoin does not translate to money. It's an asset type, and for the most part, it's an asset type that doesn't live under a known regulatory regime, and that's an immediately scare away from most business. So while I very much like kind of the big picture vision of that direction, it poses an immediate question, and that's how are you going to drive volume to the blockchain that you can actually work with and create services around. That's going to get very hard if what you're trying to ask business to do, that's to enter this unknown regulatory gray zone. where that they cannot explain to their accountants or counterparties, and that's a kind of very difficult place to enter. And then meeting up with Sven and Monero, we saw, well, but here's actually a paradigm where you can kind of get the best of both worlds, because you can still do things on chain. We did this on Ethereum, which shows that you can actually do this kind of thing on a public ledger, but still in a well-defined regulatory environment. And you can have all the promise of creating broad kind of community-based efforts that are open, versus some of the more locked down enterprise blockchains. So to me, that was a very nice proof point.
To give add some background from the perspective of Monerium, we were lucky enough to be early in blockchains, and the founding team also had experience from capital markets and central banking and regulatory. So we started out soon after Ethereum was launched. We realized the potential of Ethereum for digitizing assets, but we realized also that the trading mainstream assets would depend upon having a reliable representation of traditional money on chain. So we looked around and we tried to find the most solid representation of fiat in digital form. And we identified e-money as the best possible form. It's a proven regulatory regime which has been in existence for over 2 decades in a major jurisdiction. So we started with the most trusted, proven, reliable form of money, and then built the blockchain interface to that, as opposed to starting from the other end. So stablecoins are, in our view, interesting experiments to a certain extent, but they are as essentially just a collection of non-uniform user agreements by private companies, which have unproven, for example, legal history. So in our view, those you can use them for certain purposes, but in mainstream commerce, they will not suffice.
Good stuff. And just quickly, I don't know how much time we've actually got left, but I just want to get this in now, because if anyone was watching this morning, our enterprise blockchain session that we're doing, I got to the point where I was asking Gert about this fantastic thing you're doing with the government of Denmark, and Zoom decided to do a global update, so we got interrupted. So I'm going to take the opportunity now to say that I think it's a brilliant thing. I should probably have said there is a story on our website about that as well. But Gert, do you want to just explain, now that we've got a moment, this great COVID relief thing you're doing? It's going to free up, I think, $55 billion from from Danish supply chains, and this can be rolled out to other places. Tell us about it.
Yeah, no. So the basic idea here is essentially that the state goes in and says, so the problem is liquidity in the supply chains. And banks are unwilling in uncertain times to actually lend money to companies. So the idea is to really turn it around and say, what if buyers would promise to pay their sellers on day one and protect the supply chains and protect the economy from the fallout that we saw during last financial crisis when whole supply chains collapsed. And banks can, of course, go in and offer guarantees, and they do that today. So you could say the only little thing we added was to say, so what if you had this the digital ledger of the transactions between the companies? So you can actually create the transparency into what is it actually that sellers are invoicing buyers, and what is the buyer's response to this, and when do the sellers get paid? So the moment you have a history and you can show you actually pay your sellers on day one, and then everything that triggers the payment of the interest by the state towards a bank. So basically give a guarantee for the payment of the interest on those early payments to sellers. That's a very, very low risk proposition, basically. So for very small budget, a few 100 millions of Danish kroners, you can actually release what is almost 400 billion Danish kroners. so could have a huge impact on society. And also, the moment the state steps out of this, you can replace that with private incentives. And as we showed in the case here with Monerium and the IKEA case, there are some obvious ways to kind of lower the risk in those transactions. And we are right now discussing this with Danish government and UK government.